Well, greetings and welcome to the Investment Strategy Brief for July 2025. We want to take the opportunity as we move through the middle of the year to frame up a little bit of a second half outlook. We don't always do this every year, but there's sort of a milestone at mid-year, so we wanted to get into it. And, to kind of give you the punchline at the beginning here, we're going to talk about the markets being resilient, there being some positive momentum in the environment, but of course with an increased risk to the downside. So first, to start off, recall that we've talked a lot about geopolitics and geopolitical risks, and we have this dashboard that we have that frames up a bunch of possibilities. But what's in keen focus as it relates to specifically the idea of something that might trigger some trouble in the second half, it would be any additional tensions and military action between Israel and Iran, and of course, especially if the U.S. gets involved. So we have this fragile piece at the moment. We hope that continues, but those are the kinds of things we'll keep an eye on and monitor for, really, as it relates to downside risks. Now, getting into it in terms of sort of the environment, we all know that we've experienced this big shift in D.C. with the Trump administration coming in around things like tariffs and trade policy, fiscal policy and taxes, and of course the spending bill, which we're going to talk about. Sort of the narrow effort of the Department of Government Efficiency, then big changes in Health and Human Services, big changes in the Department of Education, big changes with immigration policy. So the watchword that's been out there for the balance of the year is uncertainty. With these shifts in policy, there's a lot of nerves around uncertainty, especially it's been around tariffs and trade, as we've talked about. Now, the spending bill, the one big beautiful bill, has been passed. And so the elements are laid out on this slide, basically permanent extension of the 2017 cuts, targeted tax relief on things like overtime, on tips, and some interest like on auto loans, essentially some increased deductions, and importantly, for earners up to $500,000, basically an increase in the SALT, the state and local tax deduction. But that sort of phases back down to $10,000 very quickly when your earnings get above $500,000. Changes in energy policy, that's not a big surprise. But then we've seen spending shifts towards defense, border security, and ICE, and then some reductions with Medicaid and things like student loan support and SNAP. Now, ultimately, at this recording, the Congressional Budget Office hasn't had time to sort of frame up the final impact in terms of their projections, but many economists sort of frame up the deficit to be at around 6 to 7% of GDP, which is a big number. We're going to get into that in a moment and see how that fiscal trajectory may pose a problem down the road. Ultimately, this is a stimulative package, so there's the expectation of up to about 0.5% GDP growth that's extra as a result, both this year and next. And then there's mixed views about the long term, but again, I'll just reiterate the idea of fiscal trajectory, that we've got deficits that we have to bring into focus, is very important. Now, when it comes to sectors, things like tech and industrials can benefit in the current environment. There's probably greater uncertainty around healthcare, for example. And ultimately, that idea that deficits and debts going up could put some upward pressure on Treasury rates. So turning to the economy, we've talked a lot about being back to trend growth. We've talked a lot about 2/3 of the economy being anchored on the consumer. And so the consumer, this retail sales chart, basically is a little bit, I don't want to say misleading, but what we've talked about is that retail sales have sort of bumped around above zero, mostly, and on net is sort of positive. We actually had recently a positive print, but that rolling 3-month average turned negative because the data point that fell off was a little better than this most recent positive print, right? So just think of it as the consumer remaining, generally speaking, engaged, but with a little bit of volatility. And we've seen a little recovery in confidence. We've seen, obviously, an increase in the debt cost for consumers and a strong labor market. And in fact, talking about the labor market, we did a little bit more of a dive on some of the data and framed it up into 3 phases. Think of it as what was normal before the pandemic, and that's the gray bar. What happened during the reopening, and then starting And then the final bar, we just have to show basically the June numbers. And so you can see the unemployment rate, for example, is just very good. So the labor market is very good from that perspective. Non-farm payrolls, not as good as the recovery, and actually a little bit below that 10-year average pre-pandemic. But then we see JOLTS, the quits rate. Remember, when this number's up, that's a sign of worker confidence. And so not quite as good as the strong reopening, but better than the 10-year average pre-pandemic. And then finally, JOLTS, jobs openings itself, essentially very strong. So not quite as strong as the reopening, but well above the levels we saw before the pandemic on average, that 10-year average. So the net takeaway from this is, while maybe something like non-farm payrolls is showing maybe a little crack in the job market, the bottom line is it's remained very solid. And so that has been sort of a driver of sort of consumer confidence. That's a driver of activity. That means when we look at the economy and economic growth, the consensus forecast is for 1.5% GDP growth for this year. And you can see the different firms, everybody's sort of hovering around that number. Now, turning to sort of the discussion on all of this and where the Fed might be headed, inflation, generally speaking, has calmed down towards the Fed's 2% target. Now, we had one print just recently, the June CPI, which was just a little bit above the Fed's 2% target, 0.3%, versus that monthly equivalent of 0.17%. But basically, core for CPI and then the producer price index, very muted. And so overall, the general score for inflation is that things look pretty good. And again, we'll see if people have been worried about tariffs making their way into these numbers. That hasn't shown itself too much, and that's the focus. Everyone's focused to see if tariffs really will have an effect. Ultimately, though, this all translates to, when you think about a pretty solid job market with maybe little teeny bits of softening, coupled with inflation being under reasonable control, the forecast, as reflected in Fed funds futures, is for 2 cuts for the balance of the year, one in September and one in December. And you can see people were more optimistic back at the end of April. Now, as it relates to that idea of fiscal trajectory, we keep talking about the need to go through a fiscal transition. You know, the bottom line is we know that the debt's up. We know the cost of debt is up. Interest rates are higher. It's becoming a bigger portion of our discretionary spending. And we've got corporate leaders and government leaders all talking about the need to rein this in. And so we know it's a particular focus for the administration. And yet, you know, the spending bill that they ultimately went with, Congress and ultimately signed by the president, still will have a pretty chunky deficit. So our view continues to be that this is something that needs to come into focus in the next, call it 5 years, plus or minus, and that it's something we're going to need to sort of rein in. And honestly, not only with the U.S. government, but across the economy, just making sure debt isn't too overdone. Now, turning to the markets, we know interest rates remain elevated, well above, for example, the lows of the pandemic. And as investors, what that's meant is various categories are still offering really attractive yields as we look forward. And so people have stepped further into the bond market. Those that had gotten away from it when rates were low, people are coming back, and investors are, you know, earning better returns as a result of that in terms of having that nice exposure to sort of a diversifying asset class that is earning a pretty good return. Now, turning to stocks have been a super interesting story, and this gives me the opportunity to mention that milestone at the middle of the year. So basically, remember, this chart represents the blue line, the average first-year term of a presidential cycle. The orange is the Trump first term, and then the light gray line is this year. And you can see that big drop down and then the recovery. So this is just a visual of what's happened. We saw with Liberation Day, the markets really fall. The peak to trough on the S&P was almost a bear market, down 19%. But then as the tariff thing sort of translated to more trade negotiations, as extensions were made, and essentially a greater sense that this was a little bit more about establishing better trading relationships, more favorable to the U.S. than just blanket tariffs. I think people have come down about that, and then you couple that with the stimulative effect of the spending bill, and there's just a little bit more optimism making its way. Anyway, that new line, which labeled target, that is the level at which our target of 6,200 for the S&P 500 would be passed. And so what you can see, and it's literally on June 30th, the S&P 500 exceeded our year-end target of 6,200 on the S&P. And so, again, we'll get into our soft forecast for the balance of the year, but it causes us to be able to answer the question, well, gee, you've hit your target. Where do we go from here? Now, when it comes to the level of valuations, we know that by a PE calculation, that classic valuation that, as we've seen before on a cap-weighted basis, the normal index, we're looking at 21.5% premium. And yet when we equal weight the index, that premium really falls quite significantly, telling us that in a more diversified way, the typical stock isn't that overvalued. And so that's I think one of the factors that has been supportive. A second one really relates to earnings. And this month I want to talk about sort of the impact almost of the psyche from Liberation Day. So if you look at the April data here, basically this is color coded. If you see a green, that's saying that a stock analyst is making a change in their forecast in a positive direction. They're improving their forecast. If it's gray, they're making no change in their forecast. And then if it's orangish red, whatever color that is, then it's more negative. And what you can see is this big jump in the negative revisions, right? As those uncertainties really around Liberation Day kicked in. And so that had an effect of sort of lowering the forecast for earnings. But then what you can see as we've made our way through time is that green bar started to grow. So the most recent level is probably above 50%. And when you add the neutral, you're probably at about 75% or either neutral or positive. And so what we're seeing anyway is that, yeah, there has been a slight decline in earnings forecast for 2025 in terms of growth, and now they've started to come back up. And again, the level is just under 10%. We think that's a good solid number. When it comes to market performance, you can see the various asset classes or categories that have recovered from the trough. So back to their peaks, the S&P 500, the S&P Financials, the Bloomberg 1000 Growth Index, the Magnificent Seven notably, the Developed Market Index called EFA, and the Emerging Market Index. And so generally speaking, we've seen, as we saw in that graph, real recovery. And gosh, when we look at the full year ended recent period, essentially those numbers are looking pretty solid across the board. So let's get to our mid-year outlook, some of the details on that. So the idea with this is to say, look, we have to take in exactly what's going on around this positive momentum. And the things that we're seeing are, increasing clarity, so a lessening uncertainty around tariffs. We're seeing so far, even with the tariff worries, inflation seeming pretty contained. We're seeing a solid labor market that will translate to as an active consumer. We're seeing, and we're calling for Fed cuts of 1 or 2 times between now and year end. All that sort of supporting continued economic growth. We had originally said for the full year a range of 1.5% to 2.5%. The consensus is at the low end of that, and we'd probably say, yeah, that makes more sense to us. Things are still positive, but just a little more muted. And then as it relates to the markets, I mentioned the idea of, in round numbers, 10% growth on the earnings of the S&P 500. All of that leading us to say, look, we want to identify a soft target on the S&P 500 for the end of the year of now 6,500. It's not quite as official, if you will, as when we started the year. And why do we call it a soft target? It's a soft target because it's a little bit directional, but we really want to shine a light on the downside risks. So we've listed them here. Think about, I mentioned the geopolitical conflict, but there's policy uncertainty coming out of D.C. There's the risk if tariffs kick in or otherwise that inflation reaccelerates, and maybe all of that leads to the consumer slowing down. And that could be sort of driven by animal spirits, sort of the positivity in the environment for the consumer, for the investor, weakening a little bit. All of that, any of those things in a way, could sort of trigger the market to move lower. And so, again, think base case, positive, modestly higher from here, momentum continuing, but with more meaningful potential downside risks looking forward. Now, I'll just take a quick minute to reiterate that we continue to focus on our long-term themes, the fourth industrial revolution, securing strategic resources, shifting demographics, the new consumer, and productive competition, really around how the world's changing over the medium to long term and what that means in terms of investing and investment opportunities. So I invite you to check out that work. If you get these slides, you'll see a link at the bottom of this page. And then finally, an invitation, as always, to go to stifelinsights.com. I'll just point out that we do have, for example, a body of work coming out for the next generation, an investment handbook, and some webinars coming up. So if you go to stifelinsights.com, you'll be able to check all that work out. In any event, I know it's sort of a packed session for July. That's what we wanted to cover. Really appreciate you taking the time to watch this video, and we'll see you next time. Thanks so much.